Coming up on the show this month, we're heading to Australia to find out how the country's top investors protect their wealth. Welcome to the show, coming to you from the beautiful shores of Sydney, Australia. I'm Oriel Morrison. Now, while our summer is only just officially starting here in Australia, the economy certainly has been red hot for a while. So we're going to be taking you on a tour today with some of Australia's top investment managers to talk about how they grow and, most of all, protect your wealth. Now, there are around 2,000 companies listed in Australia, so it can be quite a daunting task working out exactly how to find both quality and value. Now, our next guest says he knows how to do just that. Roger Montgomery is one of Australia's leading advocates of value investing, so much so that he's just written a book called Value.able. And according to Roger, the first step to protecting your wealth is to buy a stock for less than it's worth.
The really important thing is to understand that there's a difference between price and value. So price is what you pay for something, but value is what you get. Now, I'll give you an example. In 1999, on the over-the-counter bulletin board in the United States was a company called netj.com. And netj.com conducted no substantial business activity of any description. They had no plans of conducting any business of any description for the foreseeable future. Now, they listed at 50 cents, or the IPO was 50 cents. They listed at $2, and by March of 2000, they were trading at $8.88. They subsequently fell to 6.7 cents and were delisted, never conducted any business activity of any description. Now, if I ask somebody at a dinner party, what's any asset worth, any asset at all, most people would say what someone else will give you for it. What someone else will pay for it, that's what it's worth. Well, netj.com traded at $8.88 a share, but it was never worth $8.88 a share. So the way to value something, the way to work out what it's worth, is to look at what its profits are doing, for example, and how much money is required to be invested in the business to generate those profits. So if I put $1 in a business and it generates 10% a year, but I want to get a 20% return on my money, well, that dollar's really only worth 50 cents.
So if we talk about criteria now, how do you decide which businesses are worth looking at?
Well, it's a great question, because sometimes you find a company that seems to be cheaper than its value, but it's not a business that has bright prospects. So you want to buy a business that has great prospects for the future. You don't want to buy a business that's going to go out of business anytime soon, because it may look cheap, but it's going to be a whole lot cheaper very shortly. And that's the other thing to remember, that time is the friend of a good business, but the enemy of a bad business. So you want to make sure you're buying good businesses. So what does a good business look like? Well, it has little or no debt. It has a high rate of return on its equity. So it's generating really high rates of return. And there's some examples I can give you. For example, JB Hi-Fi generates a 45% return on its equity. Contrast that to QR National, which is going to be listed. And that is a business that generates a 5% return on equity in 2 years if all of the forecasts are met. So you'd much rather buy a business where you're laying out $1 and getting 45% return every year, rather than a business where you're laying out $1 and getting a 5% return. So that's the second thing, high rates of return on equity. You want to buy a business that has bright prospects for its future. So it's going to sell more widgets, or it's going to be able to raise prices for the widgets that it's selling without the volume sales dropping. And that's the last thing. The thing that drives that ability is what's called a competitive advantage. And you want to get a sustainable competitive advantage.
You would think that a lot of that's got to do with the people that are actually running the company. How do you go about putting a value on management?
Well, here's the interesting thing. I actually think the boat you get into is more important than who's rowing it. Let's take an example, Virgin Blue or Qantas. Doesn't matter who's rowing that business. We've got John Borghetti and Alan Joyce running those respective businesses. They can row to their heart's content. They can be Olympic rowers, but there's dirty, great big holes in the side of those boats, and those boats will always be sinking, and they'll forever be distracted by bailing that boat out. They won't be able to row that fast.
All right, we've valued the company, we've got a list of companies that we like to buy. How do we decide when to buy, when to get out? Let's talk about the timing aspect of investing.
Well, I don't think of it in terms of timing, because I think that's speculation. I really think that trying to time markets is really, really difficult. Even the guys in the world who have made billions of dollars doing it will openly admit that they don't get the timing right. What I prefer to do is price businesses. So I'm working out what they're worth and where that value is going. So if I can find a business that's worth $4 and next year it'll be worth 5 and the year after it'll be worth 7, the year after it'll be worth 10, well, that value is going up at a very good rate and I can buy it at a big discount to $4 today. So I'll buy that particular stock. If it meets all my other criteria, I'll buy shares in that business and simply wait for time to take its course, for the business to perform, for management to do its job. And provided that value rises, as I suspect it will, then over long periods of time, while the market is a voting machine or a popularity contest in the short term, over the long term the market gets it right and price follows value.